Many of us would look at this picture and think, yes, if money was no object, where would we rather be right now? That applies to your clients as well. And I'm not sure why you came here today, but you're in the right place if you want to find out how to master your money, create your wealth, retire early, and all just on your current income. Now, this presentation is normally given to retail clients. If you're here, it's because you're in the financial services industry. This is for people who are financial planners, mortgage brokers, money coaches, accountants, ex-financial planners, ex-bank staff, or financial services qualified people. So what we're going to look at today is how you're going to turn your filing cabinets into cash drawers. You're going to realize the value that's already sitting in those filing cabinets. When you've sold policies to clients, you've got to go and look for new clients because servicing is generally not profitable. So new clients are where the new money is. You've got to keep finding new clients. But if you could turn your existing clients into and generate more income from them, that's a much smarter move. You're leveraging what you already have. You're going to look at how you can value add your services. So in other words, what you do already is obviously very, very important. But the reality is your clients are looking for far more than that. You don't know what their financial position is at this point in time, but you will by the time we finish with this program. You're going to find out how it can easily generate referrals for you, because once you have very happy clients, the best business that you can get is from referral business. And the way that this program is being set up, it's been designed to do exactly that. You're going to find out how to increase the value of your business, because having valued clients on board who aren't going to leave you just increases the value of your business. Plus, with the referrals coming in, it's an ever-growing business. You're going to look at how you can generate income streams. So once you've sold something to your client, that's all that you're really going to make from them, other than perhaps generating renewal income streams. And with the way that commissions are going out the window and fee for services coming in, it's going to be a lot harder to justify to your clients why you should be continuing to get paid a fee for service and why you should be doing this before doing that. What I'm going to show you is when you work with a client and you say, I'm more interested in you as a person than I am in you as a policy holder, clients are going to love you. You're going to be able to show them this program and you're going to say, look, this is what your future looks like, but you need to take measures to protect it. And that's why we're doing this, and that's why I'm here to work with you. So let's keep going. I don't want to keep harping on. For those of you that don't know, my name's Nobby Kleiman. I used to be a financial planner for 20 years. I've given advice for 30 years. And I left the financial planning industry in 2006 when it became, when the fun went out of it. All the compliance and auditing and everything like that. And I was spending 90% of my time doing paperwork instead of being out there doing what I loved, which was speaking with clients. And I'm sure that you are in the same position today. That's not where you want to be. I can give you ideas and tips on that as well, but that's a separate conversation to have. So what we need to know today is, what is the world's largest industry? And it might surprise you to learn that according to Google, the alcohol industry is the largest industry in the world. But is it really true? Money is obviously the largest industry, and the proof of that is simply the amount of debt that is incurred in countries. At the moment, $19.297 trillion. I mean, this is just craziness, but it is money, and so therefore it's huge business. Even in Australia, $461 billion. There's nothing to equate to it. This is countries that have this debt. This is not the individual people themselves. This is the countries. So one of the things as financial advisors that we've always known is there was always these little stories that would come out of 100 people who start working at the age of 25 today. By the age of 65, now this is in 40 years' time, 29% of those people are going to be dead. That's not a good story for a lot of them. By that age, 1% are going to be considered wealthy. 4% are going to have enough money put aside for their retirement. or so they think. 3% of those people are still going to be working. 83% of those people save nothing for retirement. 80% of those people from ages 30 to 54 don't believe they're going to have enough money put away for retirement. 63% are going to be dependent on Social Security, friends, relatives or charity. And this is very, very prevalent today. It's already happening. 36% rely totally on Social Security. A third of the people relying totally on Social Security. We know the numbers that the taxpayers just aren't there to be able to fund this. So therefore taxes have to increase or benefits have to come down. So this just can't keep going on. 13% of the population are already going to be over the age of 65. So they're already relying on Social Security and their pensions. And, you know, they deserve it. Men aged 65 in, let's say, 2013 have a life expectancy to age 84. That's about 21 years after the age of 63. 21 years, they've got to have enough money to live on after retirement. And women, it's even more. It's 24 years. And with modern technology and science, people are living even longer. So money is going to have to last a lot longer. One of the big problems today is the average savings for a 50-year-old male is $42,000 to $43,000. That's not very, very good. $43,000. The average person will earn $1 million in their lifetime. Now, if you're a financial planner, it's not hard to work out. 40 years at $25,000. That's an average all the way through without taking salary increases. But of course, you know, people don't think of that. But they get to retirement and they're in a lot of trouble. With the Australian Bureau of Statistics, they recently did a survey, and through their numbers, and they found that balances in superannuation funds were by far the largest financial assets held by households. Now, I think this was back in 2011 when this was done. And for those of you who are from overseas, superannuation is the Australian equivalent of your retirement fund. So for those of you in England and in the States, it is retirement plans. 80% of households had some superannuation assets, but the distribution was very asymmetrical. And what that means is that while the average value of superannuation or retirement funds for those households was $132,000, half had superannuation assets under $60,000. Now that is a very, very frightening statistic. So, you know, it's not saying that those who got to age 65 had $60,000, but the financial asset of most households was $60,000. Not very good. This will explain it a little bit more as asymmetrical, being that $2 million is the 1 to 2% people. Get up here. Here is your average, the bulk average of 132,000, but of that, half of them had 60,000. So the biggest number of people, the percentage of the population, had $60,000 or less, where the average across the whole range was 132,000. And so that's obviously not very, very good. In Australia, and this applies across the world because my research has shown me that across the world, baby boomers and populations are pretty much, you know, closely aligned. Western countries such as Australia, New Zealand, America, Canada, England, even South Africa to a degree, have a lot of these numbers in common. 35% of baby boomers consider themselves as completely unprepared for retirement. 51% consider themselves somewhat unprepared for retirement. So between those two, you've got 85%, 86% of the population who are not sure that they're going to have enough money for retirement. 14% considered themselves to be financially prepared. But it's interesting that 46% are not confident of their ability to maintain a comfortable standard of living in retirement. So when we were talking before about people being in retirement and living for the next 19, 21, 24 years, they're not sure about the level of lifestyle that they're going to be able to afford in that time. One of the biggest problems is In America, 30% of people who are aged 65, so those who get to age 65, in America, 30% of them, of Americans aged 65, will do so still owing money on a mortgage. In Canada, the current number of people retiring with debt on their mortgage is 50%. And in Australia, people retiring at age 65 with debt on their mortgages is around about 45%. So we're all fairly closely aligned. You could say anywhere from 40 to 50% of people retire with mortgage debt at some level. So what's gone wrong? Why are so many people getting to retirement and being so underfunded and retiring with debt? And there are different levels of underfunded and different amounts of debt. But in societies where technology is freely available to help people, as well as self-funded retirement plans, why do so many people fail to be adequately funded or prepared? It's not your fault as a financial advisor, I can assure you. The answer is not that difficult to understand. After World War II, the economies of most Western nations boomed and flourished, and everything was paid for with cash. And when the cash ran out, so did the spending. So most lending from banks was for property, and the interest rates were fairly substantial. So the banks made a lot of profit. But they also provide a far more personalised service, and if you put your savings into a bank account, you could actually get paid interest on that money. Doesn't happen today, does it? But of course, times change. The world has become consumed by debt, and everyone ends up paying for it. Not everyone ends up going through life constantly owing money. There's a number of people who manage their money and live within their means, and yet even many of them don't have enough money put away for retirement. They scrimp and save, they pay their mortgages, and they buy the second-hand car, and they stay living in the same house all their life and everything like that, and they live fairly modestly. But when they get to retirement, they are supplemented by the pension schemes that are available, or Social Security, and they make a living of it. But times are tough because few ever allow for the cost of living increases, and they can become far more rampant than the value of their money. So you need to be able to take that into account when doing planning. When I was a financial planner, I was getting one question more often than any other, and always from women. And they would say to me, I don't want financial planning, investment, insurance, or retirement advice. Just tell me how to manage my daily money. You see, what was happening was they weren't coping on the household income. They were running out of money before they ran out of month, and barely living from one paycheck to another. It's even harder today. Nothing has changed. They're still struggling to make ends meet. They're looking for the same solution. Unfortunately, I was pretty glib back then as a financial advisor, and as any financial planner or accountant will always tell someone, the answer is simple: spend less than you earn and pay the highest interest debt first. Perhaps even get a second job. It was pretty glib, wasn't it? So while they knew that the advice was correct and they agreed, they stared at me waiting for more information. That was it. And most had a look of disbelief on their faces, as if it can't be that simple. You and I both know that it is, but to other people, they're overwhelmed and they're looking for more. You must be hiding something. So I could see that what they wanted was a push-button solution. And 2 years after I left the financial planning industry, I still wanted to help people with managing their money, and the same questions kept ringing in my ears. We all think someone smarter will figure out how to fix the problem, but as time goes by, and no one does. So I looked around for a solution, but I couldn't find anything that met my exacting needs. So here's a quiz for you. Where do you do your best thinking? Is it while you're out walking, while you're washing the car, while you're cutting the grass, laying in bed, or in the shower? And I can tell you that one morning in the shower, the answer came to me. I sat down to work it all out and eventually realised it was based on the same system I had used to eliminate all of my debts and create my own wealth. This is the information that banks and lenders don't want you to know about. What I ended up developing was a program which is pretty much a push-button solution based on the same system I used to wipe out my debts and to create my wealth. I had 4 credit cards. They were all maxed out, and that was when I started as a financial advisor. But within 12 months, I had wiped all of that debt out. I had taken all these certain steps, followed that through, And I can tell you that it worked an absolute charm for me. And what I didn't realize when I was developing this program was it was based on the same outcomes, and everything was done in the same manner that I had followed through to get rid of my debt. So it's just like a roadmap for your financial future. If you follow the program, you will end up debt-free and having enough money to live on in retirement. So, do you want to see how it works? Let me take you through this program, which has revolutionized how people are approaching their debts. Okay, so what I'm going to do here is just take you through the basics of the program so that you get a good understanding of it. Everything's got to work on income and expenses, and then there's some reports. So Money Rules works on regular income. So this is all known income. It is a proper cash flow management program. So the first thing we look at is Sam and Sally's income. So here's Sam's income, it's $3,300 per month, and everything is calculated monthly. The starting date is the date that it's entered, and the ending date is the date that we know the salary is going to stop coming in. Same with Sally's. Sally's is $1,150, although hers is fortnightly. It's now calculated on monthly. Again, the date that it starts and the date that it's going to end. We can see they've also got interest income from a bank account. There's child support from the government and family allowance as well. So here's their total monthly income of $6,300. What we're going to do then is go and have a look at some of their expenses. So they've got their primary property, it's worth $450,000. $300,000 mortgage on it, they pay it monthly, that's their monthly payment. 3.95% interest rate. Number of payments, they've only just taken this out, so they've got 30 years or 360 payments. Based on monthly, it's a variable rate, and it's with which bank? Any editing needs to be done, we just click on the pencil and make the changes. Then we'll have a look at their personal debts. And as you can see from their personal debt, they've got a car loan, they've got a couple of credit cards and a couple of personal loans. The original amount of money that they borrowed, this is the date on which the information is entered, and this is the current balance as at that date. This is the interest rate for those loans and what their monthly payments are. And we also give them an option to be able to choose a priority, which one's most important to them. So that tells us something about them. And to Sam and Sally, 10 is the highest, that's the most important. They want to get rid of this credit card, so we can have a look at that. If we look down at the bottom, you can see it mirrors exactly the same as up above, and what it's telling us is they've got a total of $53,000 in debt. They're going to pay $16,500 in interest over a 98-month period for a total of $69,890. So let's go and have a look at their regular expenses. So here are their regular expenses: utilities, transport, fuel, education, medical and personal. And you're going to find that personal is the place that you're going to do a lot more work in. The pie chart here, this has been designed for women because it gives a better overview and a breakdown of expenses. We can see here $1,730 for food, which is up here. Men look at the bottom line number. Women like to look at an overall picture. So that's why it's been designed in that fashion. And the whole program has actually been designed and developed for women, but men also get to enjoy it when they see it. On the left here, we've got the traffic lights. Red being danger, obviously. This is non-discretionary expenses. This is money that needs to be earned and debts and expenses that need to be covered. Otherwise, something will be turned off and taken away. The non-discretionary is the amount of money that they decide to spend on whatever. But we can see that they've gone overboard and they're actually spending an extra 8.74% of their total income. And you'll remember $6,300 was their income. Well, 8.74 is $667 over spending. So they can only do that in one way, and that's with credit. So they need to move the green from the bottom to the top. The green is good, and we need to get the green to the top. And we'll show you how to do that shortly. The saving report. And this is the one that people will generally rush to have a look because they get a pretty good overview of their whole situation. Remember, we had $53,000 in debt, $16,000 in interest, and a total of $69,000 that they were going to pay over 98 months or 8.17 years. We haven't selected a strategy as yet, so we've not saved them any time, but we know that they're going to be out of debt in 8.17 years. We come down here, here's their mortgage at $300,000, 3.95% interest over 360 payments or 30 years, and they're going to pay $212,000 in interest on top of the $300,000 they borrowed for a total of $512,000. But here's the interesting part. We know they're going to be out of debt here in 8.17 years. They haven't had access to this money because they've been paying it off the debts. If we can show them how to take that very same money and save a lot of money, I'm sure that they're going to be interested. So take that money after 8.17 years, drop it on top of their mortgage, and instead of going for 30 years, they're actually going to be out in 16 and a half years. Instead of paying $212,000 in interest, they're only going to pay $121,000 in interest. So we've just saved them $91,500 in interest, and you saved them 13 and a half years. Now, anybody who can't see the advantages in that is obviously not looking. But we can do better than that, and we'll find out how. Let's go back and see how we can fix up their mess with their overspending. So the first place we'll go into is their regular expenses. And within their regular expenses, you're going to find most of the action takes place in the personal spending. This is where people have no idea where they're spending their money. So we can see that haircuts, that Sally is spending $60 a month on haircuts. She feels that she can probably stretch that out to every 2 months rather than each month. It's on a month-by-month basis, so it's going to be totally up to her. Sam has committed to finally quitting smoking, so that's coming back to 0. And then when we look at clothing, Sally's setting aside $50 per week for clothing. She's going to change that to monthly. When we look at drinks and alcohol, Sam is spending $50 per week on drinks. So what he's decided to do is cut that back by half, and he's going to make that fortnightly. And the last one in there is they are spending $100 a month, putting aside for a holiday, which they can't afford in any case. So we've convinced them to leave that for now and come back to it at a time that they can afford it. So if you have a look over here, you can see we've already got some green to the top. We've gone from the bottom and we've gone up to the top. But we can do even better than that. We happen to know that within the food section, Sam has been spending $100 a week on buying his lunch. So Sally said, you know what, you can buy your coffee at work, but I'm going to make your sandwiches for you. And the other place that they're spending money is $100 a week on takeaway. So what we've said is, let's just modify that and make that $150 once a month, and you go out and really have a good night out. So they've agreed to do that. So we're going to leave it at that, but let's have a look at what's happened. We've gone to 14.75 or $930 positive. So we've gone from a negative of 8.7% or $670 up to 14.75 or $930. And another place that we can go and make a change is in their debts. We're going to select a strategy. Now, as financial planners, we would automatically say pay the highest interest debt first, whereas some other people would say pay the smallest amount first because it's a psychological win. But we've got a number of different strategies that we can run through here, but we need to be able to show them so that they understand for themselves. So in the strategy here, what we're going to do is we're going to go through the list. Snowflake is the lowest balance, and you'll see the lowest balance is 1,000. Keep an eye on what happens to the interest and the months to pay off. So we'll click on that Snowflake, which will put the $1,000 to the top, and there's the $1,000 to the top, but we've gone from $16,000 down to $10,127, and it's over 36 months. So that's a pretty good deal. What about highest interest first? And that's gone down, dropped by about $80 to $10,082. It's still 36 months. What about the order that it's been entered into the table? 10,930, so it's gone up, still 36 months. So we won't use that one. Let's look at the highest priority first, which was theirs over here. 10,459, it's gone back up again. Still 36 months, so we won't use that. And what about reversing that and making it the lowest priority first? Dropped it a fraction, but not enough. So the best of the whole lot was, in fact, the highest interest rate first. So now let's go and have a look at what that does in the saving report. So in the saving report, you'll remember that we had $53,000 and $16,500 in interest, $69,000 to pay out in total over 98 months or 8.17 years. But we're down to 3 years and we're saving them $6,500 in interest. And we're saving them 5 years. That's not a bad result. If we take the money that's available after that 3 years and drop it on top of the mortgage, instead of paying out over 30 years, they're out of debt in 9.33 years. That is a fantastic result. Instead of paying $212,000 in interest, they're going to be paying $67,500 in interest. They're going to be saving nearly $145,000 in interest, and they're going to be saving just under 21 years. That's not a bad result at all. So as you can see, instead of paying $212,000 interest here, which equates to this one, they're only going to be paying $67,000 in interest, which equates to this. Instead of paying for 30 years, they're only going to be paying for under 10 years. That's not a bad result. As a client, I think I'd be very happy with that if you brought that to me. But let's go and have a look at a yearly balance report. Now, what the yearly balance report does is it says, here is the conventional method of paying out your mortgage, $299,000 at $300,000 when it started. And at the end of 9.5 or 10 years, they would still owe $236,000, but they're down to zero because they used the Money Rules program. Here it is in a graphical. Here's the 30-year mortgage term, but the green represents the Money Rules method. So that looks like a pretty good result. As a financial planner, I know you're going to enjoy seeing the Future Value Report. What the Future Value Report does is paint a very long-term picture for your client, which will cement you as being able to give them a picture of what the future could look like if they knuckle down. So what we're saying to them is you're going to save $151,000 in total in interest. You're going to be debt-free 21 years ahead of time. And if you take the money that you're saving and invest that, you can do very well. So let's have a look at that. Here's the available surplus. Here's the mortgage payment. When they're both added together, we're talking about $3,600. They're going to use that same money over the 20 years at the mortgage interest rate of 3.95% as a rate of return. We look at that, you can see that the red section here is the original mortgage term of 30 years, but we've got them out of debt back here in under 10 years when they would have still owed $240,000. If they take exactly that same money that they're now being able to save and invest that into a retirement plan, investment plan, whatever it is that they decide to do, they could actually end up with $1.4 million. And that is at 3.95%. But just as an example, that's not a bad rate of return. And most super funds are actually doing at least double that, if not better, at the moment. They turned around and they said, you told us that if we stopped spending today so that we could live tomorrow like most won't be able to, then what we want to do is we actually want to put aside $2,000 per month over that same 20 years at that same interest rate. What will that do? And that will actually give them in the vicinity of $783,000. So it's $1.4 million or $783. Go back to that asymmetrical graph that I showed you. Most people retired with $130,000, but half of those people had less than $60,000, and 50% of the population on average had mortgage debt by the time they got to retirement. This is where most people are living. They have zero by the time they get to retirement. But because you've been able to show them how to save their money and invest it for the longer term, they're not going to be a burden on the financial system of the country. They're not going to be reliant on Social Security like 36% of the population or 70% of the population. So overall, this is an excellent outcome. This is something that you should be taking to your clients and making them sign up for. There's no reason why somebody seeing this wouldn't be so enamored with their future financial plan. And the good thing is, you're not responsible for this, they are. But as a financial planner, I can talk to you about how you can work with your clients to do this on a more formal basis. So let's go back to the webinar and I'll catch up with you in there. And so Money Rules was born. Why don't banks and financial institutions give you access to these sorts of tools? And it's simple, because they want to have control. They don't want people to think for themselves. They don't want people to stop paying their outrageous fees and charges. They don't want people to stop contributing to their bottom line profits and bonuses. So imagine what life is going to look like for some of the people already in the program with the time and money they're going to save. So we're going to have a look at a few of them. And here's James. James has no personal debt. He's been very, very good. And in fact, he's got a mortgage of $598,000. James is going to be saving a lot of money. Let's have a look at what he's got here. James is going to save $250,000 and he's going to save 13 and a half years. And here's Sherry's account. Sherry's a teacher in Queensland. They had enormous problems. We got onto Skype and went through everything with them, and we ended up giving them a far better outlook than what they previously had. They were going to end up saving $162,000 and they're going to save 15 and a half years. They're going to, instead of paying over a 28-year mortgage period, they're going to pay out in 12 and a half years. Now, that's not bad going. They're very happy about that. And the beauty is there is an offer that's coming up later you'll hear about. And what I did was say to Sherry, you're a teacher, talk to teachers. So there you go. There's something for you to think about when we get to it. And here it is. This is what Sherry's saving. $152,000 and 15 and a half years. Here's Jen. Jen's an interesting lady. She's a midwife, a doula. They're going to end up saving $205,000 and 11 and a half years. Very, very happy lady. Joanne's a lady who lives in Adelaide. Bought 10 properties for the retirement plan. Therefore, that's why you'll see all these numbers up here. We're talking that she's going to save $2.4 million. Current balance is 119. They're going to end up paying a heap of interest. But she was having financial problems and went to the mortgage broker, went to a financial planner, went to an accountant, and they all said to her, sell one of the properties. And she said, I didn't buy them for my retirement plan just to sell them. There's got to be another answer. When we put the information into Money Rules, we found out what was actually happening was she was running short by $800 a month. And I said, can you find $200 a week? And she said, yes. She came back 2 weeks later. Her story was that she loved teaching children piano, and she picked up 13 children in that 2 weeks, was teaching them piano. She also got 2 weeks back in her old job, and she was on 6 figures. So she got 2 weeks back in her old job, and she also got a $10,000 tax refund. And she said, well, so what do I do with the tax refund? I said, put it into the program and it will tell you what to do. Very, very happy lady. Can't speak highly enough of the program. So she was going to save nearly $2.4 million and 10 years. Roger lives in England. So the figures that we're looking at here are pounds. Roger had $111,000 in debt, and he was going to pay a whole lot of interest over a very long period of time. Roger had really got himself into some trouble. And we actually ended up working it backwards. I said, Roger, this is how much you need to earn to pay these debts off. So Roger got stuck into it, and lo and behold, he's well on his way to working it all down. Let's have a look at what Roger ended up with. Saving £53,000 and 22 years. It's the 22 years that he's more concerned about rather than the £53,000, although that's still a lot of money, over here. 22 years is a long time. Heather and her husband ending up saving $112,000 and 12 and a half years. So these are just similar sorts of stories that you're going to find everywhere. People put this information in and it just opens their eyes up. And what they say very quickly is, I never realized I was wasting so much money. It was slipping through our fingers. I didn't realize I was paying that much in interest. And my comment to them is, you've got to get greedy with your money. I say that to everybody. You too readily give away your money to the banks and the lenders in the form of interest. First thing to get under control is credit cards. So let's keep going with this. Money Rules is not about paying off debts. It's about results. And I've shown you that some of the results that other people have got. It's about lifestyle. It's about future security, comfort, peace of mind. Being able to leave money for the kids or to help them out, or setting up a future fund. Money will buy you what you want in a lifestyle, but understanding how to pay for it as quickly as possible is what makes the debt affordable. Having control over your money is the most important factor in what you do with your money. If you don't control your money, then someone is controlling you. And if you're paying off debt, then you're working for somebody else rather than working for yourself. Remember when we said that that number was down to 37% of the population have less than $60,000 in their retirement account? So how much do you have, and how long do you think it would last if you stopped working today? At the age of 50, the average savings is $43,000. And in my life, I work with two words: focus and leverage. Focus on the end goal, become laser focused on the end result, and I know the sort of retirement I want to be able to have. You need to think about that now, because it will be harder to achieve the longer that you wait to decide. Now that you've seen the program, you're going to be able to say, there's my goal. That's what I want to achieve, and this is the time within which I want to achieve it. So you can now do this for your clients. What we're looking at here is, this is after it's been optimized. This is saving 15 and a half years, and it's saving $221,000. If they put that total aside of $6,000 a month, they could end up with $1.7 million. And if they put aside just $2,000 each month, they could end up with $583,000. Or they could just continue doing what they're currently doing and end up with very, very little when they get to retirement. This is a missing puzzle in financial planning. What you're doing is, you're going to your clients and you're saying, here's your income and here's your lifestyle, and you need to protect it, because if anything happens to you, your total lifestyle is gone. What Money Rules does is, Money Rules actually uses the numbers that they give you, that they put into the program, that they're responsible for, and it says your whole lifestyle is dependent on your income. There's no financial planner telling you how much insurance to buy. The program is saying to you, your total salary is at risk if something happens to you, and so therefore you need to insure it. As your financial advisor, I'm here to provide you with insurance that will meet that risk. And that's what you're doing. You're doing risk assessment. You're doing risk minimization. People like to hear about tax minimization. Talk about risk minimization. Talk about asset protection. Talk about future protection. This is what people want to hear about. They don't want to hear about insurance. They want to know what it will do for them, not what it's going to cost them. And I think we're all in the same boat. It's with them. What's in it for me? It's not, it's costing me money, I can't afford it, it's a drain on my income right now. What I need to hear as a client is, your future is at risk. This is your future. This is your lifestyle. You need to protect it. I'm here to do that for you. I'm here to reduce your exposure from 100 cents in the dollar to 2 cents in the dollar, to 5 cents in the dollar. Go back to the old selling methods of real cost. Ben Feldman, perfect example. Just trying to think of some of the other guys, but they're perfect examples talking about risk minimization. 2 cents in the dollar to protect your $100,000 income. Why wouldn't you do it? It's a smart way to do it. When people think it's a couple of cents in the dollar, it's not the monthly premium of $100. It's a couple of cents on the dollar. I just get passionate. I'm still passionate about it after all these years. So I think you should be as well. Looking after your client's best interest. So there you go. So let me keep going with this as I race through it. Doesn't matter where you are in life today, this program is everything. It will transport you from today into the future. So what's the purpose of all of this? It's freedom, it's lifestyle, it's free from financial stress. It's planning for the future and knowing it's already secure. Your clients can do their own planning. They don't need you to be there to do this miraculous planning. They've got their real dollars to work with. I know accountants who are charging $10,000 up front and $3,000 ongoing each year to do something similar, but it's nowhere near as comprehensive. They're using spreadsheets which are constantly out of date every time a payment is made or an interest rate is changed. They actually dread the spreadsheets they're using and trying to keep up. But they told me they won't be dropping their fees anytime soon. And why? Because they're making money. Until people know that there is an alternative, others will continue to make money at someone else's expense. So the program normally sells at $697 US dollars. Let's not get confused here. That's $697 US dollars. And the reason it's US dollars is because we are turning into a global community, whether we like it or not. And many things are priced in US dollars. So if you're in Australia, I'm happy to talk to you about working out a conversion. But the reality is everything is worked out in US dollars. It just makes life so much easier. We don't always sell it for that. Another thing that happens is Facebook group gets set up for members so they can get in there and they can talk to each other. One of the important things is making sure that they have success. So success is you working with your clients on an accountability basis. And I can talk to you about that at some stage as well, because what I'm doing right now is I'm going through the retail side of the program. I'm not going through the financial planner side of it, because there is that side of it if you're interested. But on a retail side of it, work with your clients, show them what they've got, give them some time. You've got to do that. Generally what I say to people is if you buy Money Rules today, I'll gift you a 30-minute Skype implementation call to make sure that you've entered all of your details correctly and that you understand how to correctly use the program. Some people only need 15 minutes, and for others sometimes it takes a little longer. But as an accountability coach, you can go back once a month, once a quarter, how often you feel or your client feels you need to. You charge for your time because your time is worth it, and you also ask for referrals. So if the program was $697 and being a member in the Money Rules private membership group is priceless, and let's say half an hour is worth at least $500, and you save 10 years at $50,000 or 15 years at $100,000, and perhaps even 20 years. If you could save 20 years, I've seen some at 20 years, $150,000 or more. So as an introduction, instead of $697, it's $497. And that's still US, so it's around about $650 Australian. I can tell you the people who've got it are very, very happy with it. And I'm running a Mad March special, and that's why it's $200 off. What I like to do is say to people, how would you like to get this for free? Because, of course, what people say is, $697, $997, it could be worth, $1 million. How would you like to get it for free? Oh, well, yeah, I would. And so what they do is you just say, okay, every person that you refer to me, you will get paid 25% as a referral. So 25% of, $497, if that's what the price is when they do the referral, you're talking about, $125? Who's going to knock back $125? Get 4 people, your program is paid for, you got it for nothing. And you've got all the information going forward into the future. Not only that, they don't have to stop there. They can keep going afterwards. They could do one a month, every month, one a fortnight, one a week, and just keep earning 25%. It could become their second business. And of course, there is a warranty or a guarantee. I guarantee that the program will work for you. If it doesn't work for you, you have 30 days. No worries. Give it a try. If you're not happy with it, if you don't like it for any reason, just return it. Just get in touch. And in fact, if the program doesn't save you 10 times what it cost you, I insist that you, firstly, don't buy it. But secondly, if you have bought it and find that it doesn't save you more than 10 times what you paid, then just ask for a refund. We'll gladly refund it. That's not a problem. you've got other ways that you can go about saving that amount of money. So there you go. So today it's going to be $497 US, around about 650 Australian dollars. There is a pop-up on the side there that will show you that. All you need to do is click on there to go to the buy page, and you'll end up at this page that looks like this. So who is this for? This is not for people who are not willing to be coachable and take action. If you are going to give me a hard time and you want to argue about everything and you're not interested in looking after yourself, you're in the wrong place. I'm not here to work with whingers, moaners, and people who just like to bitch and moan about everything. But I am here to work with people who are serious about their future. I'm here to work with financial planners, mortgage brokers, accountants, anybody who wants to grow their business through seriously helping their clients. This is something that you can do. That I talk to financial planners about this in a separate situation as a business, because as I said, for financial planners there is a different opportunity available, and I'm happy to talk to anybody about that. You just send me a message and I'll talk to you. You don't have to stay a financial planner for the rest of your life, but you can work with financial planners and run this as a separate business. And I think you're going to find that money coaching is going to be a far more lucrative opportunity to be able to work with a far bigger group of people, because when 80% of the population don't go to see financial planners, it's because they have a number of reasons. They don't believe they have enough money, they don't feel comfortable with financial planners, and you and I both know there's nothing wrong with financial planners. The odd one, okay, fine, it happens, but they're becoming less and less. But as a money coach, it's far more palatable than being a financial planner. And as I said, I have no problem with financial planners, but money coaches is something that perhaps people are going to be looking for. And that can lead into far more things. You can start thinking about leverage. For people who are thinking it's a get-rich-quick scheme, I don't make any promises. Whatever work you put in, whatever effort you put in, and whatever return you get, then that is totally up to you. And if this is going to cause you financial hardship, do not spend a cent at all. But this program is for you if you know that previous options have not worked for you. So if you've done budgets and things like that and they haven't worked, forget it. This is not a budget program. This is a money management program. I don't even like to say that it's a cash flow program. It's a money management program, but it will obviously work on cash flow. It'll work for you if you want to have control over your money. So if this is like a weight loss program, if you want to lose that weight, if you want to lose that debt, if you want to get control over your money, then this is the tool that you put into place and you send it to work. It's like going to the gym. You give it a workout, and when you work that plan, you'll find that the money will work for you. You know that you want to change the way that you're living now. If what you've got now is not good enough, it's the same for me when I had 4 credit cards that were all maxed out. Do you think I was happy with that? Do you think clients across the world are happy living paycheck to paycheck? They're not, but they have no control because they don't know where to start. So if you are not happy, if they're not happy with the way that they're living now, they need to have this program, this tool, so that they can start getting out of the hole that they're in. When you're in a hole, don't keep digging. You've got to start filling it in so you can get out. I hope that makes sense. You know that you're having trouble managing on your own, so if you need help, this is where an accountability coach comes in handy. Get someone to work with. Tennis coaches have coaches. Swimming stars have coaches. Singers have coaches. Smart people have coaches. If you're having trouble managing on your own, get someone to help you. There is nothing like reaching out and saying, please help. And people are more than happy to help. So that you've been looking for guidance and direction, then here is something that will guide you and direct you. And if you want a roadmap to guide you for your financial future, it's all laid out for you. The whole program is there in front of you from now right and through until whatever date you pick. So then you know that this is right for you. Refunds, as I said, I've invested many thousands of dollars in money, years of time, and a lot of education and learning to bring this program to those who want it. The program has already worked for many people, but not everyone is diligent. Some people do slack off, we know that. And so that's why I'm offering a 30-day money-back guarantee. So far, no one's ever asked for a refund, and if you're genuine, then I don't expect you to be the first. And if you have any questions that I haven't addressed, then just write to me, ask@moneyrules.com.au. If you're a financial planner and you want to find out more about a certified consultant program, I'm happy to talk to you about that. Also, write to me at ask@moneyrules.com.au and I will get back to you. So there you go. My name is Nobby Kleiman. I'm an ex-financial planner, and I hope that you've enjoyed this presentation and it's brought you some good stuff. I'll be hanging around. Just put your questions over here in the column, in the right-hand column, and we'll go from there. Make sure that you tick them as a question. So I'll speak to you there.